Welcome to Wealth Beyond the White Coat, a show where we dive deep into the world of financial freedom for dentists and medical professionals. I'm your host, Darren Flesher, a dentist with a passion for uncovering the strategies that lead to a prosperous life beyond the office. Every episode will explore the avenues of alternative investing, tax mitigation, and secrets to build wealth that the textbooks don't teach you. Whether you're looking to enhance your financial literacy, discover new investment opportunities, or simply find a better way to manage your money, this is the place where your financial health is the core of our conversations. Welcome to Wealth Beyond the White Coat, where your journey to financial clarity and freedom begins. Welcome back to part 2 of our discussion on due diligence with David Singstock of Mick Law. In this episode, we'll continue to peel back the layers on what it takes to protect your investments by understanding both the people and the processes behind them. So in this second part of our series, get ready for even more valuable takeaways as we dive into specific case studies and real-world scenarios that illustrate the importance of thorough due diligence. So some of that stuff's really black and white. If you've got a legal history, the bankruptcy, something like that's going to jump off the page. But I imagine there's some more nuanced stuff where it's maybe you have a subjective opinion on like some of those things like answer and did they get back with you? And I assume you guys have some of that stuff that you run across that you might have an opinion on, or maybe interests aren't aligned, the way people get paid. Can you share some of those, how you guys weigh in on that, or if you don't, and what that looks like for you guys in your process?
What we want to do in our process is I know in pretty good fashion what a broker dealer and investment advisor, what they would want to see. So if I have a sponsor that I'm looking at that seems to be a little short on some of the requirements that I think my clients would want to see, I'll tell them, hey, I think you need to do this. I think you need to make a change in your investor controls. I think you need to make a change in how investors might be able to remove a manager, just things like that. And they can decide to not do it or not. I don't represent them, so I don't care. They don't have to do it. But I know if it gets in front of one of our clients, they're going to say, this is not really investor centric. So we're going to hold off on it. Then they're going to have to go back to their attorneys that are doing the drafting and resubmit an amendment to their LP agreement to put the provisions in there that then will maybe allow that broker dealer investment advisor to get that comfort. So we're trying to beat around the bush a little bit on that. Let's make sure it's going to be something that even makes sense before we do it. And that's part of having an opinion on things. And we could always say everything's fine, but what's that help? How's that helping our client? If we just tell them, hey, everything looks great, or we're not going to opine as to whether or not we think that provision needs to be changed. So that's really an important thing. On the background search thing, you got to remember the obligations to place certain information on background. A lot of times is only put at 10 years in a PPM. So if something happened in year 10 and a half, they may not be required, or their counsel may tell them you don't need to put that in the PPM anymore, which is perfectly acceptable. But we think that maybe our client will want to know about something that happened in year 11, especially if it was really germane to what's going on. Securities fraud, how about that? Securities fraud, they or absconded a client's money or something like that happened, or tax evasion issue or unpaid taxes that happened. These all just go to it goes to the thought and the feeling of the people making decisions. And a lot of times it's just that. The comfort level has to be there with the group to invest with them. So if you knew that they don't pay their taxes and they don't do that, it may not be required to be in the PPM, but we'll put it in our background and litigation search. We'll say that. And the sponsor's not real happy. They'll come back and say, hey, our attorneys say we don't need to have that in there. I'm like, you don't have to have it in there, but we're going to disclose it and let our client make a decision whether or not they think that's germane enough for them to make a decision. We think it's important for them to know, so we're going to give them that info. So those are the big difference between sponsors getting upset when that's placed in the opinion, and they don't think it should be in there, but we think it's important still. So those are real nuanced things like that I think are important that they may not be required to state, but we believe we're required to, and we want to give that information to our clients so they can make the right decision.
Yeah, great. One thing that I've come across, unfortunately, recently, I've seen something that was a conflict of interest as far as how things operated. The ownership of the asset was managed by a lot of the same people. And when you really got into it, it felt like there was quite a bit of conflict in who controlled the entire kind of vertical. And sometimes that's a positive in that you got kind of centralization. So how do you approach potential conflict of interest in how you run things? Do you have conversations with the operators? Is that something you guys weigh in on? How do you guys do that as far as your process?
I think mostly like in the offering memorandum, private placement memorandum, you'll notice that over the years, the risk factor section's gotten longer and longer, right? Now it's like everything that you could possibly think could ever happen is now listed in there. And it's all about protecting the sponsor from not giving information to a prospective investor of things that may or may not exist in the future. So they've really gotten long, and that conflicts have happened too. I think conflicts of interest, the starting point with that should always be they exist. So what does that mean? Because not all conflict of interest, like you said, Darren, are bad. Because if the person's really good at what they do, there's no reason why they shouldn't be able to make decisions on several fronts. No different than, for instance, an asset. A lot of times a sponsor will currently have an asset in their portfolio. They acquired it a couple of years ago because they got a really good deal on it, right? Maybe it was a seller that needed money. They needed money fast. So they were able to acquire this asset. They've done some work on it. They've made it better. And now they want to take that asset and wrap it into either a limited partnership structured offering or a Delaware statutory trust, 1031 exchange type offering. And okay, is that bad? Okay, not necessarily. Are they getting a new appraisal on the property so they can verify what the valuation is as of the time they're making that transaction? What has been done? What are they selling it to the investors for? I'm always leery that when the sponsor tries to take all of the meat off the bone before they sell it to the investor.
So,
right?
David, let me interrupt you right there
Yeah.
because you're talking about markups. And so, explain what a markup is, how it works, how it's completely appropriate in numerous settings, and in some settings it's not appropriate.
Yeah, listen, we're in a capitalist society, right? So everyone's trying to make money, including the investors, including the sponsor. Believe me, if the sponsor didn't make any money, they wouldn't be packaging these offerings for investors. There's inherently markup in an offering because number one, if you've got a broker dealer involved, there's going to be a commission involved as well as usually a managing broker dealer fee, right? And then you have an offering and organizational expense markup, which is usually 1.5%, for instance, sometimes less. I'm just giving you a rough average of the total market. So if they're raising $10 million, 1% of that might go to the offering costs, of some of which might be the costs associated with the lawyers putting together the private placement memorandum. Brokerage fees are going to be anywhere from 5 to 7%, for instance. A managing broker dealer might be 1 to 2%. So just right there, you're at almost a 9 to 10% markup. And then the sponsor in a lot of these offerings will take a fee associated with the transaction. So if it's a single asset deal and they're going to take this asset and move it into or sell it to the limited partnership or the 1031 exchange vehicle, they may take a fee of 2% of the valuation of the property, value of the property, sometimes higher, sometimes lower, but they're going to take some fee associated with that transaction. And so you really have to monitor those fees, make sure that they make sense under the structure, and make sure that
one thing Matt
Yeah.
says to investors is this is the most expensive product you will ever buy, non-negotiable, the most expensive. But all the rates of return that you hear about or that are projected are net of all those fees. So it is a win in that regard that if you get the rate of return you're expecting net after, that's okay. But to your point, this stuff happens. Like I know 2 energy deals right now. One has 0 markup, one has 20% markup. Now, that may be good, that may be bad. There's other factors to consider before you say you should do one or the other, correct?
Financial freedom is about making the right moves at the right time. As practice owners, we often reach a point where growth stalls. Instead of maintaining at that plateau, consider cashing in now, putting that money to work for you, letting it double, triple, or even more over the course of your career, and then go pursue more of what you love to do. This is exactly what I did with my friend JW, a dental practice broker who found the perfect partner for my practice, maximized its value, and optimize the deal terms. He offers a free valuation for those considering a sale. If you want an introduction and the same red carpet treatment shown to me by my friend JW, email me at darren@legacypointgroup.com. That's DEREN at legacypointgroup.com. And I'll be happy to connect you with JW to start your journey to financial independence.
Yeah, because now it's even different. Now you got Reg BI. So now you have the best interest standard that individuals have to look at. Before you had what was called reasonable basis due diligence. You just had to determine that that specific offering gave a reasonable opportunity for profit or investor capital return. It made sense to put on your platform, and it made sense in a reasonable conducted review for that specific investor. Now with Reg BI, it's two steps now. You really have to take
BI. Tell them what BI stands for.
Best interest. So it's regulation best interest. So now what's basically happening is broker dealers have to make sure that security or that investment strategy makes sense as it's compared to its peer group. And then also as it makes sense to that specific investor's portfolio. Does it make sense for what he or she is trying to accomplish in their overall investment portfolio?
But everything you're talking about here is in the due diligence ecosystem. And when you go direct to retail, all of this is circumvented. There is none of this whatsoever. It is truly the Wild West. You are flipping a coin unless you know what you're doing.
Correct. Yeah, that's really what's happening. That's really the difference is you're trying to get through all of these hoops that are necessary for a sponsor to raise capital this way, or for a broker dealer to feel comfortable with a specific offering to put it on their platform, and then to make that decision for the investor. All these are steps that if you're going direct to investor, you're going in based upon what a sponsor told you in their little write-up about their investment, or their little pro forma on how they think it's going to project returns over a 5-year hold, for instance. And you're signing it away based upon that and the couple pictures of that really nice Class A multifamily property that they're investing in. That's all you have.
What they're telling those investors today, and we've heard multiple times, is look, you're rich, you're sophisticated, you're an accredited investor, you're smart, you can do your own due diligence. And if there was a broker or an advisor in between you and us, it would only increase the cost and lower the returns that you would be delivering on this product. So you're a smart, sophisticated guy. You can do your own due diligence to determine if this is something that's investable for you or not. And they're playing into the ego of a high net worth client. Well, you can figure this out yourself. And they're taking all the risk controls and all those safety mechanisms that have been built over the years of things for 20 years of you guys doing this. You just mentioned before, the risk disclosure has gotten longer and longer because you've seen different things become a risk over the years that people should be aware of. And that's just not being communicated. You brought something up before. You said there's about 15 to 22,000 deals, private placements per year that the SEC, because how many of those would you say, in your honest opinion, get any type of third-party due diligence whatsoever? Right? 20% at best or less?
Yeah, probably not even that. No, some of the really big groups will still there's some of these large due diligence groups that like Mercer and that'll do it for multi-billion-dollar raises. That's usually not something that even that average accredited investor is really involved in. So our sweet spot is those transactions that are going to be placed in front of an accredited or sophisticated investor that allows them to invest in kind of an institutional style investment that they wouldn't otherwise have access to, utilizing these prepackaged offerings and properties. I hate to say it, but being accredited or being sophisticated doesn't make you smart. It just doesn't, not in this little realm. It makes you smart at what you did to get that money, but it doesn't mean you know anything about how an investment needs to look or what it needs to be structured like for this, unless that's how you made your money as an investor in these types of offerings. But that might make sense. But the vast majority of people, like Darren, you and I were talking earlier, my father-in-law, who's an anesthesiologist, I don't think I've seen someone lose more money on these upstart companies that everyone's telling them this is going to be the next thing. You're going to get 30 multiple within a year and a half, and they go out of business after 12 months. So it's like I don't think my father-in-law looks at it and thinks that he thinks he's smart enough to invest in these things because of everything he's accomplished in his life. But I don't go into a doctor's office or in a surgery room and asked if I can do the anesthesiology, right?
Well-
Don't do it.
Well,
Right?
you
I don't know
brought
anything
something
about it.
up there. So first off, 20% of the 20,000 might get due diligence.
Like,
Of the 20,000, how many, in your opinion, are actually investable?
Hey, I just want to interrupt real quick and say thanks for listening to the podcast. If you didn't know, we have an associated Facebook group also called Wealth Beyond the White Coat. Over there, you can ask your questions, get feedback from group members, and have a close community of medical professionals who are likely interested in the same things as you. Whether it's alternative investing, tax mitigation, ways to keep more of your money, or even protect your assets, we're going to discuss those things in the group. Additionally, we have a private investors club called Legacy Point. As a member, you'll get exclusive discounts to preferred vendors, and you'll get access to private investments that you'll find nowhere else. Whether it's hotels, apartments, oil and gas, equipment rental, you name it, we'll be discussing those details and offering those investments to members only inside Legacy Point Group. If you want to learn more about that, please contact me or simply email info, INFO, at legacypointgroup.com or go to the website legacypointgroup.com. And Wealth Beyond the White Coat podcast listeners get an exclusive discount if you use the code WealthBeyond. That's all caps, all together, WealthBeyond at checkout. I'd love to have you in the group, and I'd love to see you making more passive income as you move towards financial freedom, whether it's freedom to retire early, spend more time with your family, go on more vacations, or just do more of what you love while you're in the operatory. I'd love to see you doing that as part of Legacy Point. So here's to improving your financial health.
oh, geez, I bet you, I would say that at least 75% of those offerings I wouldn't even touch. I personally wouldn't touch. I probably wouldn't touch 95%, to tell you the truth. But 75%, yeah, it's a great idea, a great concept.
So, David, what do you think about? So, Matt and I, we own a tire shop. We get really rich in a tire shop. We sell our tire shop. We're like, we're no longer in the tire business. We're pretty good at investing in real estate deals or all these alternative deals. We're going to start a club for people to be investors in our real estate deals. We'll call all these other tire shop owners who all make a lot of good money, and we're going to charge them a fee to come be a part of our club, and we're going to show them deals. Now, Matt and I are tire shop owners. We don't know anything about deals. All we know is something about tires and how to run a business. And what we've seen groups like this pop up all over the country in all different industries. And like when you hear something like that, what's your take on something like that?
Yeah, there are a lot of them. I think I've ran into at least 3 to 4 groups in the last year and a half that for some reason or some way have found out that we looked at a specific offering or a specific sponsor. And the sponsor says, oh yeah, Mick Law did due diligence on us, so you need to get their opinion. And so they'll submit a request for us to get an opinion to them, of which we come back and say, we're not providing your opinion to you because you don't have any reasonable obligation to do any due diligence. And they mostly don't. They're groups of 10, 12, 14 people that come together, pool their money and look for investment opportunities. But the thing is, they don't have any obligation or requirement. So ultimately what they end up doing, they're not our client. We have to have registered people be our clients because those registered people know how this works. They know what the expectations are, and what their expectation is a professional that's putting these types of products in front of people. These other groups, I think they can be successful, obviously, but I just don't know.
I would argue they could be successful for enriching the people who start the groups.
Yeah, I just don't think it's not something I would want that I would recommend people look into, because it's just ultimately that they're putting you in front of opportunities that no one's vetted, really, right? They just look like something that may make sense based upon their limited exposure and thought on what's out there. So
Darren sent me a screenshot of the commercial real estate brokerage, a Collier's newsletter that was talking about one of these groups. Didn't specify the name, but was talking about one of these groups, and basically it wasn't speaking very highly of it.
Yeah. So going back to these types of deals that are probably not really investable, but they're really accessible, which is what people are drawn to and how easy they are to click buy now and get into them. passing through your hands, passing through your ecosystem, I'm sure there's some surprises, some red flags that have really drawn your attention and maybe changed what your opinion on the deal, or maybe the broker's opinion on the deal, and made it to where they ultimately didn't end up offering it. Can you expand on that and maybe share some examples of surprises that have come across? I'm sure you see it all the time where somebody probably seemed okay. Obviously, they're probably coming to you hoping to get passed through and shown to people. What's popped up as it's passed through your hands that's really changed the investability of a deal that you've seen?
Yeah. And I think over the years, it's gotten, I wouldn't say less, but it has, but I will say less. And the reason why I say that is that I think it gets out there that we're probably going to not have a very positive review of a group if they have significant background issues or performance issues or a number of things that could pop up. We're probably not going to recommend that product or that sponsor to our clients. So a lot of these groups that are thinking about coming to this space, but then go through the process of understanding, okay, we need to have someone help us on the third parties, or help the broker dealers on the third party due diligence side of things. If they know that we're going to probably give a negative opinion, they won't come our direction as often. They tend to deviate to other areas that aren't going to really maybe dig into that and give an opinion on it. But overall, it's usually background, it's usually performance. Those are the two big ones. And believe it or not, you think people that have background issues would think that that's probably going to be a red flag or something that's going to be to make people look at their group as maybe one that they wouldn't want to invest with, but they don't. And a lot of times this stuff pops up and we got to decide what's germane and what isn't, right? If a guy is 60 years old and he got an operating while intoxicated when he was 19 or 20 or 22 years old, whatever the age was, but is that something that should be reported in, for instance, our opinion? 38 years ago, he got that. I don't know. I don't know if there's a perfect answer. I think we start by putting it in there, and then we have to go through the process of determining whether or not this is something that is really, it could really probably hinder it more than it should, because you're going to have certain people saying, if it's in the Mick opinion, then it's something we don't want to even deal with. And how do you do that? It's a little bit of a balancing act on that. Securities issues, background issues that are going to be really involved with fraud, things that really what people are looking at as it relates to an investment are probably something that's more feasible to be reported than it would be, for instance, the example I just gave. But it's usually there. It's always, if it doesn't make our opinion, every one of our clients has the ability to request a copy of our whole due diligence package for our background checks, our research that's done by our paralegals, and we can provide that, and they can make the decision on that if for some reason slight circumstance didn't make it in there.
Yeah, so tell me if I heard you correctly. So some of these people might be self-selecting. They know that they might be coming in with some bad news. And so the fact that they don't have your opinion might tell some of the story in why they didn't go seek that opinion. We're not saying that everybody that doesn't have a third-party opinion is necessarily bad, but that could be some of the reason why that doesn't end up happening, because they know that they're going to get news they don't want to hear. All right, that wraps up part 2 of our discussion on due diligence with David Sangstock. We've covered some critical ground, from the importance of transparency to the red flags that can save you from disaster. Stay tuned for part 3, where we'll conclude this series by tying everything together and providing actionable steps for investors to follow in their own due diligence process. See you next week. Thanks for listening in to Wealth Beyond the White Coat, where time and attention mean a lot to us. If you found value in today's episode, please consider leaving us a review on your favorite podcast platform and share it with your colleagues and friends. Your feedback helps us grow and reach more professionals like you striving for financial freedom. Until next time, keep pushing the boundaries of your financial health. Thank you for joining us on this journey to wealth beyond the white coat.